Investors, it is certainly not too late to be shopping the market for discounted dividend stocks. And a matter of fact, it's actually an ideal time to do just that. After the latest report on job openings spooked the entire market, and our latest employment report depicted everlasting strength, which I am sure has Jerome Powell and the gang over at the Federal Reserve up in arms, but more on all of that to come. If you're new here, I'm Ari, your dividend investor with all the latest need-to-know economic insights and dividend stock ideas on a weekly basis, with 7 more for you today. So with that, let's dive right in. Now, as always, before we dive in, I'll give you the up-close and personal look into my portfolio as it's currently sitting at $115,584.64, which is still down by roughly 11 grand from weeks ago when we were all in greener pastures. And while I see plenty of investors kvetching about the amount of volatility out there and running away from the market, I'm actually here to share a few thoughts with you. First, subscribe, because if you go back to my videos from a few weeks ago, I have been sharing that we would inevitably find ourselves here in the red. Honestly, anyone with any sense of their macros could have actually shared the same with you and have emotionally prepped for all the market mayhem. But more importantly now is to embrace the market volatility and, a matter of fact, wish for more days worth of it, because over the next 5 to 10 to 15, 20 years from now, today's worries will be long behind us, and if you're not investing now, you'll have missed the greatest opportunities to take advantage of discounted dividend stocks. Now, I do want to brief you on where we stand economically, not to try to predict the future with you because no one can, but to get a grounding for where we are, to anticipate where we actually might be, and ultimately come to understand how aggressively we should be investing right now. I will share with you, however, that I do not think this is it. We are not in the clear just yet. No, sir, and likely we won't be out of the market muck for a while. Why? Well, for one, job openings were reported, and as economists expected 8.8 million, the reported depicted 9.5 million openings. Not to mention, on Friday, our latest employment report also depicted more labor market strength. Now, this all matters because the Fed designed a strategy to essentially cool the economy and inflation by raising interest rates, to which they are now likely to raise interest rates again and keep them elevated closer to a terminal rate of probably 5.75% plus. That means there's a cost to borrow money, and when that goes up, of course, ultimately we are talking about consumers being impacted in businesses as well, as the environment turns to now one of the survival of the fittest. So the market this past week, upon digesting all of this news, fell. No, it plummeted. And I think we're in for more weeks worth of volatility as we just experienced. As for the government shutdown scares, I want you to know that that deal was struck between the Dems and Republicans really just kicked the can down the road, and we should be revisiting this entire storm of fear, I guess you can call it, in another couple of weeks. So please don't take them seriously with all these crazy headlines, and just join me here on the channel where I hopefully can stop you from a full-out panic attack. Now, where does this all leave us as investors today? Well, with 7 more dividend stocks to add to your watch list, with our first dividend stock being arguably one of the most reliable dividend stocks that is not necessarily one I chose for a crazy dividend growth, but more so for sheer reliability. We have Coca-Cola, ticker symbol KO, which is the world's largest soft drink manufacturer with literally hundreds of brands under its operation worldwide, but of course maintaining its iconic Coca-Cola brand, which I cannot ever see losing its ground. Now, Coca-Cola is probably never going to be trading at a steep discount, but when it begins to slide into fairer share prices like we're seeing right now, it's such a wonderful company, down almost 11% on the year, trading for $55 a pop with a PE ratio coming in at 22.7. I'm saying take a look into it. And while many may disregard it because of its lack there of growth, well, we have over 40% worth of growth over the last 5 years. So of course, smart money is going to be going to town on Coca-Cola as they have been scoring more shares, and analysts remain bullish with 28+% worth of upside, coming to a share price of $70.91 per share. Now, as for the dividend insights, over 60 years worth of dividend growth at a 3.4% growth rate and a current yield of 3.34%. Next up, we have Raytheon Technologies, ticker symbol RTX, which is down by over 29% year to date, trading for around $70 per share with a PE at 18.7. Now, usually I talk about Lockheed Martin or General Dynamics, as some of you may know as my go-to defense contractors, but Raytheon is right up there, providing advanced systems and services to government agencies, the U.S. military, and consumer clients as well. A matter of fact, as of this past Thursday of last week, they just signed a $39 million deal with the U.S. Air Force, and about a week before that, we had a $305 million contract with the U.S. Navy. So business is booming, and as it's been now for a while, up nearly 40% over the last few years. As for analysts, we have bullishness across the board, as well as forecasted share price at $89.58. That's 27% worth of upside. And now getting into what we are all going to be enjoying as dividend investors, Raytheon's dividend at a yield of 3.37%, growing at a 5.29% 5-year growth rate. Now, investors, if you're getting value from these listicle type videos, let me know so I can make more videos just like them. That's all that you're going to need to do to let me know is literally tap on that thumbs up button, and I'll keep cranking videos out just like this. With that, dividend stock number 3, Restaurant Brands International, ticker symbol QSR, or probably better known for their brand names here like Burger King, Tim Hortons, and Popeyes. Either way, this fast food gem has slid over the last 6 months from $77 per share to around $64 per share at a P below 20 at 19.3. Now, I've recently been talking all about the golden arches in my last few videos, but I cannot ignore now the quality of Restaurant Brands International, and nor can hedge funds as of recent who have been loading up on the stock. Now, personally, being a huge fan of Bill Ackman and Restaurant Brands being in Bill Ackman's Pershing Square portfolio, the king can find a place now in my portfolio any day, especially with analysts predicting over 20% worth of upside to a share price of $81.71 per share. But being in it for the dividends, you would capitalize on a 3.43% dividend yield with plenty of growth at a 7.02% growth rate. Next up, United Parcel Service, or better known by their ticker UPS, which is the world's leader in logistics and is currently, well, not delivering as its share price has flopped to $153 on the year with a PE sitting at 13.3. But rest assured, UPS will soar again in a healthier economy. After all, zooming out, we can see 51% worth of growth, and when shipping expenses come back down, analysts are anticipating that we will get 21% worth of upside for the share price to rise back up to $187.22 per share, while hedge funds also load up before the rebound, adding almost 500,000 shares to their portfolios. Now, until a full rebound, we have a stock with a 12.38% 5-year growth rate with a current dividend yield sitting at 4.22%. Now, if none of those previous stocks actually fed your investment appetite, you're going to salivate over this next one. Darden Restaurants, ticker symbol DRI, which is my go-to favorite restaurant holdings company. It's a dominant restaurant operator with the most popular U.S. brands under its operation, like the Olive Garden, Longhorn Steakhouse, Seasons 52, the Capitol Grill, and Eddie V's Seafood, all of which are very affordable. And at the end of the day, regardless of what happens on an economical front, consumers who desire to consume will find themselves, at least at some of the times, enjoying some of Darden's restaurants. So when this stock falls over 7% over the last 6 months with a PE ratio now at 17.4, it finds itself back on my watch list. And how could it not, with almost 48+% worth of growth over the last 5 years? But I will share that as I looked into the insider trends, it looks like we had a mixed bag. And I would assume then that we might get some more downside from Darden if the market continues to trend as it is. However, for the longer term, upside of about 23% is expected from analysts. And until then, we will be able to feast on a 3.71% dividend yield that is packed with a 13.35% growth rate. Next up, a rather boring yet very lucrative dividend investment with Texas Instruments, ticker symbol TXN, a semiconductor manufacturer that, of course, has been hit with the lags and jags of the supply and demand shifts, as well as rising interest rates, which has prompted a sell-off in, well, now we're looking at a chip player at $157 per share with P at 18.9, but it remains a powerful long-term bet with over 77% worth of growth over the last 5 years alone, and factoring in bullishness from analysts here at a forecasted share price coming back up to $184.94. That's almost 17% worth of upside. Add it to your watch list given its ability to also deliver dividends. Speaking of which, we have 17 years worth of dividend delivery with a growth rate at 14.87% and a current yield at 3.29%. Now, investors, as for dividend stock number 7, Some energy here because it's a real power player. We have Lowe's, ticker symbol LOW, which continues to take a beating as do-it-yourselfers really pause on doing it themselves and home builders are slowing down on building, meaning lower revenue forecasts for Lowe's and a share price that's now free falling from $233 per share, now around $199 per share, along with a PE at 19.7, which all makes for a perfect time to buy given almost 100% worth of growth over the last 5 years, which is likely to continue onward and upward over the next 5, to which analysts foresee nearly 25% worth of upside to a share price of $248 per share. But don't just invest into Lowe's for the share price appreciation, be in it for the dividends as well, as they are growing their dividends out for decades now with 59 years worth of growth history, a strong growth rate at 19.97%, and currently yielding a 2.20% dividend yield. Now, investors, drop a comment or two down below with all of your thoughts on these dividend stocks. And if you enjoyed this video, well, something tells me that you're going to enjoy this one right here. But before you go ahead and click away, be sure to subscribe to never miss a single video.